Hello, traders. It's 7:47 a.m. Chicago time on the Tuesday. well, Tuesday, the 6th of February, 2018. Thanks for joining me. This is the day after the large correction across the markets in the U.S. and globally. It's going to be a short one, unfortunately. I've got to be somewhere urgent here at about 8:05, so in about 15 minutes or so. Unfortunately, the timing is not good on this, but I wanted to make sure I got Trader Bite in. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Let's jump right in and look at where we are. Here we go. Review. Yesterday, the main expectation is responsive, opening up at about 41.50, and we expected it back at 27.60, which I thought was pretty generous, 20 points up. We ended up absolutely hitting that responsive buy. As I commented on Twitter, I missed the one entry that set itself up. For the long, and I ended up watching, unfortunately. So, excuse me. Didn't do very much with this, unfortunately, but, and I didn't want to FOMO scalp it. And end up, going deep in the hole ahead of the market regaining its range. So that was the primary scenario. Secondary scenario, the market does not get back into the range and falls off and makes it down to 27, 25, 24, potentially the gap down at 16. The tertiary scenario was an open test drive down and a push to 16 right away. The fourth scenario is strong responsive as buyers buy the dip. We've seen these V bottoms quite a bit. And then we push through and we're looking for 27.80 as the target on strong responsive buying on a trend day. So a big impulse up. Here's what happened. There you go. It's about as much as you can see in the normal scale. This is my normal scale, 60 points for the 15-minute chart. So this is what I normally see. Yesterday's range was outstanding. It was 3 standard deviations wide. That occurs about 0.5% of the time statistically. So let's look at that. Excuse me, I keep losing my voice. Let's look at that here in the big picture. This is the daily composite RTH only. If we look at the scale here for range, right down here, these are the statistics for range. The normal range could be anywhere from 6 to 20 points in the ES. 2 standard deviation limits, 40 points. Beyond 40 points, we get into 3 standard deviations. I don't look beyond that. And then when I look back in time to see when the last time was that we hit this sort of range, we go way back to 2015. So we're going to slide our way back to 2015, August of 2015, right here. This was on the China news, 119.75 points. The next day, 87.25. The day after that, we got 67.50, and then the day after that, we got 46 points before we actually returned to what we would perceive to be normal, which is 19.5 points inside of 1 standard deviation once the market turned back up. So this fall here resembles very closely what we did yesterday or since Friday and yesterday. And the market is likely to find its footing, its bottom somewhere near here. Note that back in 2015, we pushed right to, of course, this up here didn't exist as much. But we pushed all the way down to the high volume nodes. We found our footing in the next key high volume node area. Some people are going to look for fibs, the 61.8 or whatever, but and that may be a coinciding mathematical retracement, but overall, I'm looking for where the auction took place, and the auction is delineated or is emphasized by volume. And so that's where it pushed, and we're looking for the same area now on the composite, and that area is just below. Now the market extended lower in the overnight, got down to about 25.70, and that's basically right in this high volume node. So we are trading. This is our template composite right here. We are trading right in this composite zone down here. With a point of control of 25.80 and a quarter, currently 25.93. I'm expecting this to cause a deceleration in the selling, unless, of course, there's something we're yet not aware of, like impending nuclear war or something going on with the U.S. military or something. But if it's a technical sell-off, then I'm expecting a continuation today after such a big impulsive range. On the day time frame, we expect the market to extend further. It is rare that we would immediately shoot back up. It is not likely. So, sorry, yeah, the overnight low actually is much, much lower. Hang on. My chart's cut off. Yeah, it goes all the way down to 25, looks like 25.29. I apologize. So we're opening, my point is we're opening right in this composite zone here. And I expect it to get tangled up. I do expect it to continue lower and to continue to test potentially to 25.50, but overall I'm expecting the market to get tangled in this 50-point range right here unless it starts to regain. If we regain and we do have strength, then the next area, and note that we're talking about composite levels. We hardly ever talk about the composite, which is this. Composite's made up of all the volume that has occurred in all time going back to this date back here. August 24th of 2013, which is the last major swing low. So the composite accumulates all of the volume and draws it to the right as a histogram. And today, we're not talking about yesterday's ranges. We're not talking about yesterday's features. We're talking about composite features. Why are we doing that? We're doing that because the OTF is in action. Because the highest time frame is operating here. The depth in the market is still very low. The ES right now has full offer depth of about 200 contracts. The full depth sums to about 200 contracts. That is approximately 10% of the norm. Somewhere between 200 to 400 contracts. That's just 10% of the depth. The liquidity has vanished. And so the moves are likely to be quite aggressive. Risk is very high at the moment. Volatility has shot way up, and those who are shorting the VIX are absolutely getting destroyed. Fortunes are being lost there. So this is likely to continue. And our goal is to monitor what happens at key high volume node areas on the composite. Our goal also is to sit on our hands if we're trading a small account. By a small account, I'm talking about anything lower than $10,000. It's probably wise to just stand aside or trade a micro FX product versus trading the ES or any full product at the moment, including the 6E. And any full product right now is extremely dangerous for small accounts. There's a lot I wanted to say about risk today because I saw some awful things yesterday, but I don't have the time. Everybody knows what the game is. Everything is quiet until it's not, and by the time you find out that it's not, your trade is deep in the hole, and there's very little you can do about it. So caution. This is an educational part here, an educational experience that we're having here when we see how the market actually moves with thinner liquidity when the OTF is in action. Now, this market is likely to find its buyers. It was seeking buyers yesterday, had some really good rotations. If you look at it on the heat map, and this was incredibly fast, you could see how the heat map is still responding in areas where there's the highest liquidity. This is all relative liquidity here that was up here. We had normal liquidity, so now that becomes the highest echelon of what liquidity was. And as the market started to fall, you could see how it became a lighter yellow to white to blue to dark blue. And what that means is as the market dropped below 2,700, liquidity shut off. A lot of participants in the market shut off their participation below 2,700, and that's why it goes blue. And then now it's black, which means there's just hardly any liquidity at all in this market relative to where we were in the morning. This is all on a relative basis. This software just simply finds the highest liquidity, gives it a dark color, and then shades everything else based on it relative to that. So it's a very clear sign that below 2,700, a lot of systems got tripped out, and the trading became very thin. I like that kind of trade. It is not recommended, but I like that kind of trade. You can see my activity right in here, down here, and up here. But overall, it is not a safe. It's not a safe environment for you to trade on. So what about today? Today is expected to have a wide range again. There is no reason why this market should slow down all of a sudden, and so the expectation overall today is it's likely to try to make a climb back into yesterday's range and profile. And there's very little here. Let's bring our candlesticks back a little bit. Where are my candlesticks? There's so much on this chart. Anyway, well, let's forget about that and look at this. I moved to a 4-tick Renko. Really, it should be a 6-tick Renko. Key area is above, right up here. I'm expecting the market, since it's trading the closing range currently, my main expectation for today is for the market to make another attempt at pushing higher. So I expect this to be a drive of some sort this morning. Remember, many people closed the day with a very poor position in the market. There are those who got into cash early and want to redeploy. There are those who have been sitting in cash and want to deploy their funds. And there are those who need to panic out of positions and reduce risk and so on. But overall, I'm expecting the market to respond, and I'm expecting it to push into the 2628 before it does get a reaction. I'm looking for an extension down on the day. This market's likely to extend the range downwards. It would be a joke for me to sit here and draw what areas I expect it to go to. This is not the domain of day traders in terms of targets and so on. But we do have a gap below us. We stopped at 2,600 yesterday, basically. So my expectation is an open that immediately pushes higher, pushes through, retests, potentially up to 35, and then I'm looking for sellers to come back in and start to drop it down into the 2570s for this afternoon. So expect, we don't generally go from 90 some odd points of range to 20 points of range. We expect it to be about half or so. As you saw earlier, it dropped from 119 to 90 something to 40 something to 20 something. It drops in about halves as far as range when the market starts to slow down. So, you're looking at from 26.35 or 26.25, you're looking at something that drops into the 70s for today. Okay, so I'll leave you with that. I apologize. I really need to run, but I can't get more detail than that. And frankly, I'm not an analyst. I'm just a trader. Been around for a while, and I've seen some pretty crazy markets. Yesterday's movement reminded me of Lehman Brothers, which were huge days to trade. Lehman Brothers in 2008. It was relatively orderly. Believe it or not, the move down, people keep saying it's a flash crash. I was there for the May 2010 flash crash. This is not a flash crash. A flash crash is a fat finger. You don't see a bid. It just disappears, and it comes right back to the scene of the crime. This is not a flash crash. This is orderly selling. This is coordinated selling all the way down. So the market is just responding the way it normally does when it hasn't had a record, when it's had a record number of up days without a single 5% correction. We've broken every record in the books here with this run up. This is only a matter of time before the market readjusts and re-auctions the areas below, and that's what we saw today. Good luck. Mind your risk. You don't have to participate. But you still should watch. This is an important time for you to sit in front of the market and gain an appreciation for how it moves, and gain an appreciation for how bad things can get when you are relaxed about your positions and your risk. Good luck.